the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped today as investors continue to monitor the state of the global economy. So if we look at the Straits Times Index, it was down 0.27% at 3,869 points at about 2:11 p.m. Singapore time, and that is with a value turnover of some 657 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI, as we shared with you earlier, closed in the green, reversing those losses we saw earlier. So it's at 3,882 points. 3,882 points, that's the closing number. In terms of value turnover, we're looking at 1.19 billion Sing dollars. Now, gainers outnumbered losers, 232 versus 213. Top advances for today we've got for you Avagar Limited, DBS and Holpa. And top decliners we've got for you HPL, Asus and Semco Industries. Now, in terms of counters to watch, we have Yangzijiang Shipbuilding, because Yangzijiang Shipbuilding reported that its year-to-date order wins for Q1 of 2025 amounted to 6 vessels worth $300 million. Now, Yangzijiang Shipbuilding said this was about 5% of its $6 billion target for the 2025 financial year. Now, elsewhere, from Singapore's core inflation coming in hotter than expected in April to how US President Donald Trump's trade negotiators are reportedly pushing the EU to make unilateral tariff reductions on US goods. We've got more economic headlines in focus. And joining me on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome back.
Hey, hi, how are you?
Good. And Ben, let's start with the Singapore stock market this time around. How did the STI fare today? Any surprises when it comes down to the biggest movers and, of course, the sectors that they lie in? We're seeing equities sort of stabilize in Asia, but how did the STI track those movements?
Well, if you start with Asia, it was pretty much a mixed bag. So Japan and Hong Kong largely up. China was down close to almost 1%, I think 0.8%. I think largely due to the, on the back of the tariff war concerns and the lack of an agreement between the US and China. Checking European markets, some markets, especially the UK as well as the German markets, are up almost 0.5%. So a lot of mixed trading right now. As you had mentioned just now, the U.S. market basically heaved a sign of relief since the House had passed the spending bill. So at least you have got one risk factor, no longer on the table, but still the larger narrative of what's happening with the tariff war, what's happening with China, Europe, and the Middle East. All that is still in play. So if you look at the performance of STI today, doesn't really appear to have any kind of clear narrative. I think it's just the stock market doing what it usually does, which is to wander aimlessly. So no red flags, but no catalyst.
Struggling for direction, Ben.
Okay, yes.
Okay, let's zoom in on some of the counters to watch. Notably, we have here Yangzijiang Shipbuilding, because the marine vessel manufacturer reported that its year-to-date order wins for the first quarter of 2025 amounted to 6 vessels worth $300 million. Now, question is how much is $300 million in the bigger scheme of things, right? Well, Yangzijiang Shipbuilding said this was around 5% of its $6 billion target for the 2025 financial year. So its executive chairman and CEO said that U.S. policies, global tariff actions prompted customers to adopt this wait-and-see approach, pushing back their decisions to, of course, order ships. How would you read into the order book numbers? I mean, if we look at shares down 5.1% at one point today?
Well, I mean, the 5% percentage, vis-a-vis the full year order book, I think that's pretty scary. But I think the narrative here is that, there has not been any agreement between the U.S. and China in terms of the, trade relations. So if this continues and after the 90-day pause is over, then obviously U.S. tariffs on China will revert back to the more than 100%. So based on, some analysis done by Bloomberg as well as other Wall Street analysts, if you have got the tariffs with more than 100% going both ways, essentially it means that the bilateral trade between the two countries drops to close to zero, except for some really, really important stuff like pharmaceuticals as well as Boeing spare parts. So the two, effectively what it means is that the two largest economy on the planet Earth is going to decouple. And of course, if you think about it, most goods are shipped via sea, right? Only very, urgent or perishable goods are flown by air. So demand for shipping capacity will obviously drop in that scenario. So not really surprising to see customers adopting a wait-and-see approach. I don't think decoupling will actually happen. I think in the end, cooler heads will prevail. And this could actually be a buying opportunity for Yangzijiang. Because if you look at DBS actually updated its research report today after the news came out. It's still a buy call, and the target price from DBS is almost double of today's last done trading price for Yangzijiang. So it could be a buying opportunity for the more gung-ho among us.
Okay, now another counter to watch for today, Ben, is Metro, which is a main board-listed property investment and development group. It sank into the red for its second half ended March with its net loss of 228.1 million Sing dollars. That is against a profit of 6.4 million Sing dollars seen in the previous corresponding period. Any thoughts on that? How far are the numbers in line with your expectations?
Well, if you dive into the numbers, the loss was mainly driven by non-cash accounting impairment losses in China property owned by either the company's associates, or the company's joint venture with local developers. So that's really an accounting item. It's non-cash, so not as if they're going to be taking money out of the bank to pay for this. If you look at the operational data, occupancy rate for almost all of Metro's China property fell compared to 1 year ago, except for Metro City in Shanghai. So taken together, if you look at the one-off losses as well as the deterioration in occupancy rate, I think that's really a reflection of the ongoing struggles, challenges in the China property sector as a whole. So it's not to say that the company is bad. It's just that that particular sector and that particular geographic location, right? It's not good at this point in time. So if you think about it, property is a very cyclical game. It is also a long game, and China obviously is a very long game. So if you want to get exposure to Chinese property, then obviously you need to be patient. I think the silver lining here, from my perspective, is that the company has booked all these one-off losses in its books already. So it kind of resets the comparison for future quarters, future years. So so that kind of changes the narrative. So in future quarters, if the property goes up in value, then of course it can book an investment gain. So that's all great. So I kind of like that if they clean out their books for future growth.
Okay. Now, Ben, let's stay in Singapore because Singapore's core inflation came in higher than expected in April, driven by this higher food and services prices. Headline inflation, though, stood pat. But what really stood out to me this time around was how the MAS and MTI noted that even though trade conflicts could be inflationary for some economies, the impact on Singapore's import prices is likely to be more than offset by the disinflationary drags from weaker global demand. What's your take on this, and what does this mean in terms of the outlook for export-oriented SGX counters? Okay,
so we're actually talking about two related but separate drivers here. So if you look at the core inflation, the acceleration was really driven by three things. So yes, food prices and services, but if you look at services, it was really about healthcare costs as well as education. So if you look at healthcare costs, education costs, as well as food prices, these are traditionally the sectors where cost increases, whether it's from local or overseas factors, it's quickly passed through to end customers simply because of what we call the inelasticity of demand. Right. I mean, in plain language, it basically means that customers cannot negotiate prices. Customers cannot say, no, I don't want to buy it. And customers have got a few alternatives. And these kind of products, from these sectors are mainly consumed in Singapore, right? So it's not re-exported. Now, the other pillar, the other driver is really the disinflationary trend. And that one really focuses on commodities as well as manufactured goods. Some of those products are actually used in Singapore, but a lot of it is actually repackaged, processed into final goods in Singapore manufacturing, and then re-exported out of Singapore.
Yeah.
So for those kind of products, you have a disinflationary trend, which means prices are coming down, and that, of course, will be a big plus for export-oriented Singapore companies. So, i.e., long story short, if you're a consumer in Singapore, sorry to say, you're going to pay more. If you're selling stuff to overseas markets, that could actually be better for you as a company.
Okay, now if you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, across the region, Japan also released its inflation print. Core consumer inflation in Japan hit 3.5% in April to advance at its fastest annual pace in more than 2 years, maintaining this pressure on the Bank of Japan, the BOJ, to continue raising rates. So, question for you, what do you think is next for the BOJ and the Japanese yen, of course?
Okay, so the background is that, slightly similar to Singapore, inflation in Japan is driven by food prices as well as energy prices, right? Apparently, the cost of rice in Japan is up 98% year on year.
Wow.
It's crazy. But of course, they use rice for everything, right? And rice is, a staple food in Japan, so it's got huge social and political implications. So much so that the agriculture minister had to resign this week over this. So it's going to be very tricky for the Bank of Japan. So it puts the Bank of Japan in a tight bind. Okay, so if you look at conventional monetary policy, the response to high inflation is to hike interest rates, right? But this is going to be a little bit complex, a little bit tricky because of the tariff war, because the trade negotiations with the U.S. has not concluded, and Japan is in a precarious position with high inflation, of course, eroding global growth, and of course the Trump policies are a little bit unpredictable, I say. So the BOJ has to kind of weigh all these factors, but because this is again, rice up 98%. It's a huge social issue. The Bank of Japan may have actually no choice but to increase interest rates by perhaps 25 basis points in the upcoming July meeting.
Okay.
As for the Japanese yen, so again, the conventional wisdom is that if interest rates goes up, then of course the currency of that nation will also go up. But I think in this case, it may not be a foregone conclusion, simply because Japan is also looking at its external outlook weakening. So global investors may want to kind of take a pause and perhaps sell some Japanese yen back to US dollars. Don't know, but let's see what happens in July.
Okay, now further away, Ben, this one pretty interesting as well, how U.S. President Donald Trump's trade negotiators are reportedly pushing the EU to make unilateral tariff reductions on U.S. goods, saying that without concessions, the bloc will not progress in talks to avoid this additional 20% reciprocal duties. And for context, this is according to a report by the Financial Times out today. I'd like to get your thoughts on the matter.
Well, I think this is coming across as very strong arm tactics to, negotiation tactics, right? To strengthen the U.S. hand, just when the U.S. and EU are entering negotiations for a new trade agreement. So, obviously two things can happen. So the EU may agree to the concessions before the talks actually start in earnest. Obviously, they will lose a lot of face, and that could be a challenge for the EU to do that, simply because the EU has got, or rather, EU is a trading bloc of 27 sovereign countries. So every one of those 27 countries must say, yes, okay, I'm going to lose face, and I agree to do that, but they'll be tough. Of course, then the flip side is the EU may say no, and, that is going to be a bit trickier also, because, you've got 27 countries. So all of them must agree to stay unified, to stay strong, to adopt China's approach. China basically came in and say, no concessions, we talk as equals. I'm not sure whether EU can show that kind of unity and strength. They tend to be quite, diverse in their viewpoints in dealing with the U.S. So not sure, but certainly it is... in line with Donald Trump's philosophy in dealing with his friends. He tends to, give the shorter end of the stick to his friends rather than to his adversaries. I'm not sure why, but, let's see what happens.
Okay, and before I let you go, Ben, let's talk about this one, because despite all that is going on in markets right now, UBS Global Wealth Management yesterday raised its year-end target for the S&P 500 index to 6,000 points from 5,800 points and initiated this June 2026 target of 6,400 points. Now, let me just have a look at the numbers we are looking at right now. At the close yesterday, we are looking at around 5,842 points. So how far are you aligned with this target, 6,000 points?
Okay, so if you look at all the forecasts from the global bank analysts, so we're talking about Goldman, we're talking about UBS, Citi, so on and so forth, the consensus median target is actually 5,900 points. So UBS Wealth Management, they upped their target from 5,008 to 6,000 points. 6,000 points is only 100 points away from the consensus, and is only 150 points, about 150 points away from, as you mentioned, the last done closing price for the S&P 500 last night. So really, it is not a significant leap. It is really within striking distance, right? So this can actually happen tonight, because it's only up like 2%, and then you're going to hit 6,000 points.
Yeah.
The challenge is this. All these targets are for year-end 2025. We have another 6 months to go. So anything can happen, right? So there are a couple of big risk factors. You've got the trade war. So I guess the assumption here is that the trade war is not going to get dragged out, and therefore its effects are going to be confined largely to the second quarter. So there's one assumption. Second assumption is that nothing else blows up. The Middle East is calm. Ukraine war doesn't go crazy, so on and so forth. That may or may not be true. Earlier this week, we had a bit of a scare where news feed was saying that Israel might be making plans to strike Iran's nuclear facilities. That kind of died down. And then the third assumption is that some kind of stability and sanity returns to the U.S. Treasury markets. Again, that is kind of a big red flag there, because since the tariffs were announced, the U.S. Treasury markets, alongside the bond market, have been doing some weird stuff, right? So, alongside the downgrade by the S&P 500, Standard & Poor's for the U.S. credit. So all these are big risk overhangs. All these things must go absolutely right in order for us to hit 6,000 points by the end of the year. We have got 6 months to go.
We shall see.
Yeah, we shall see. We shall see. You are right. We shall see, yes.
Okay, thanks so much for the insights on a Friday evening, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.